Hello, everyone. Just give us a few minutes while everyone trickles in here. Thank you very much for your time this afternoon. Um, I'm David Dziekanski. I'm a portfolio manager here within the Title Financial Group. We are the ETF think tank sponsored by Title Financial Group. We assist asset managers in launching ETFs in all types of complexity and asset classes. We're very excited to have Ron Insana here today. First, I'll pass it over to Dan, and then Ron will introduce himself. And very excited to share some of Ron's knowledge and get some insights on today's markets. So, Dan, if you wouldn't mind.
Hey, Dave, I like this new format, by the way. I like how you introduced me too. That's great. So Dan Weiskopf here. I am portfolio manager at Title and also a member of the investment committee, blockchain ETF. So Ron Insana here joining us. He is CEO of IFI AI, where we'll learn more about it and how they help both retail invest as well as institutions. So Ron, you may not know this, by the way. I used to be an investor in FNN. So I remember
Wow.
when FNN was acquired. Makes me old, by the way, right?
Not only do I remember when FNN was acquired, it'll be in 2 weeks, 40 years since I started at Financial News Network, June 11th, 1984. It was a Monday, which it will be again this year. And I was a film major in college and could not find any work. Neither Steven Spielberg nor George Lucas bothered to ring me up and offer me a job. And a buddy of mine from high school was working at FNN in '84 and got me an entry-level position, which obviously rather radically altered the arc of my life. And so I've been at this for 40 years. When we went bankrupt in 1990, General Electric, NBC/CNBC, when it went into a bidding war with Dow Jones to acquire Financial News Network. And thankfully, CNBC won. It did turn out to be a rather fruitful arrangement, and just passed my 33-year affiliation with CNBC back on May 22nd.
So, what are some of your most favorite interviews you've done
Oh,
over
gosh.
the course of your time? Just
Yeah,
give us a couple of the ones that really just stick out and you'll just always remember.
Yeah, first presidential for sure. President Clinton, I got a call from the White House. A former CNBC producer was working in the media and communications department at the White House and basically said, "Look, it's between you and Neil Cavuto. We're going on this anti-poverty swing through Appalachia. Would you like to interview the president and travel with us down there?" And I said, "Well, listen, let me get back to you. I'll think about it." No, I said, I jumped on it immediately. I said, "How do I lock Cavuto out of this completely? And how do I score this interview?" I had the good fortune of getting it. And so President Clinton and I traveled. I did not sadly get onto Air Force One, which was the one thing I really wanted to do, but we went down through Appalachian, Kentucky, and then on to a furniture factory in Clarksdale, Mississippi, where enterprise zones were at the time a very hot topic of how to lift people out of poverty. It was the very end of the kind of Clinton years. It was in 1999, and they had one. They felt they had one economic job left, which was to eradicate poverty. And so that process was ongoing. So we did an interview in this furniture factory in July in Clarksdale, Mississippi. And let's see, that was about 105 degrees, about 100% humidity at the time. I had a boss who insisted I wear a hairpiece to cover what is now more visible. And Clinton, thank God bless him, didn't want to wear a tie or a jacket, so we kind of just went khakis and a shirt. But we were both sweating like Nixon in 1960. It was a great experience, and he and I went on to do 6 more interviews over the course of both his presidency and after he left office, and so that was fascinating. Warren Buffett. My best Warren Buffett story is actually not the interview, which I did with him in, I think, 2004 in Omaha, which was a very great experience. He's a remarkably normal person to sit down with. But early on at my time at CNBC, Joe Kernan and I were doing a stocks to watch segment, which used to come up at the end of every hour. And we were talking about our favorite Berkshire Hathaway companies. Berkshire was reporting earnings, and mine, having come from Los Angeles at FNN to CNBC in Fort Lee, New Jersey, my favorite company was See's Candy, which you could not at that time get in New Jersey. You could only get it in Southern California. And Kernan's favorite company was NetJets. So 24 hours later, in fact, less than 24 hours later, I walk into my desk, my office, 2 two huge boxes sitting on my desk, and I open them up. There's 10 pounds of See's candy. I open the envelope and it says, "Thanks for the mention, Warren." So I call him up and he takes the call and I say, "Hey, listen, that was really nice of you. You know," I said, "Really appreciate it." And he said, "You're going to share that with the office, right?" And I said, "Absolutely not." I said, "I'm going to leave 1 pound here. I'm taking 9 pounds home because I can't get it." And he said, "Tell Kernan he's not getting the jet." So, and listen, there are countless others. I sat down with Mikhail Gorbachev. I sat down with Ozzy Osbourne. I've sat down with Sarah Jessica Parker, Dom DeLuise. I mean, just these kind of like off the run interviews. But then, some of my favorites included Bob Rubin, George Bush, George Soros, Julian Robertson. I mean, really, kind of over the course of 23 years of doing that full time, I had a pretty great experience of getting to sit down with some really remarkable people. Hillary Clinton, a whole host of other female executives, Anne Mulcahy at Xerox, all of whom were really fascinating. My own boss, Jack Welch, which was always kind of a pain, quite frankly, to interview the boss. If you're too hard on them, God knows what happens. If you're not hard enough, then everybody around you is killing you for going light on the boss. So, over the course of my career, it's been fascinating. And then the one thing I will say, and this also, by the way, includes Bill Gates, Steve Jobs, and others, they were all insanely curious. And what was most interesting about a lot of these interviews, after the camera went off, they were asking me questions. They were terrified in a certain sense. I don't mean that in the way it sounds. If they didn't know something and if they thought somebody else might have a nugget that would help them, they would ask. It's just this level of insatiable curiosity that I always found particularly among business people, politicians, Bob Rubin, people like that. It was always a two-way street. It was always very, very interesting to be involved in that conversation. Oh my goodness. Just by the way, while we're speaking, Donald Trump has just been found guilty on all 34 felony charges.
Wow.
All 34.
We'll touch on that in just 1 second. I want to first apologize for whatever left turn you took in life that downgraded you from those interviews to joining us on this show here today.
No, this is the new world, man. This is what it's like now. I mean, this is part and parcel of the communications revolution. It's the democratization of the process.
Do you have any initial thoughts on the verdict?
Yeah, I mean, all 34 counts after 11 hours of deliberation. A presumed jury of the president's peers in Manhattan. Now, granted, I would argue that there are probably that would not be the best place for Donald Trump to face charges in Manhattan, where I think from personal experience, I could say being around people in New York, he is not the most beloved character in the city. So I don't know if that would influence a jury's position on this. But the speed with which they came back and now have found him guilty on all 34 counts, look, this is a historic moment, right? And we're sitting here talking live, and thankfully it's live and not taped. This is the first time a president sitting, which cannot happen, but a former president is brought up on felony counts and now convicted. I mean, this is truly historic. Now, whether or not it affects the campaign, whether it mobilizes more people to support Donald Trump in November or more people to walk away from him, I think is an open question. But it's truly historic. And the fact that they didn't find any daylight to find him not guilty on any of these counts is in my estimation, quite surprising. My bet was, and a half hour ago, we found out that this wasn't true. I was betting on a hung jury. I was betting that at least one person would hold out on one or more of the counts and make this an impossibility. But this is staggering, and I think I don't know if there'll be a market reaction. I'm not sure how markets will respond to this, if they think it would reduce the likelihood of Trump's current lead in the polls, and then take away the probability of further tax cuts, more deregulation come 2025, things like that. I would think we're going to have to think through this, but it is clearly historic, and in my mind, it's staggering that they came to that conclusion so quickly that he was found guilty on all 34 counts.
Yes, you guys can hear me, right? Okay, cool. It is staggering, right? So we have a convicted
felon, actually.
Politician. Felon is president. I mean, that's kind of a statement of our, regardless of your views That's kind of a statement about our country. Oh, scary. A lot scary.
Yeah, I mean, I think what's also intriguing about our constitutional system is that a convicted felon cannot vote, but can run for office, even from jail. If the president were to be incarcerated, pending appeal, I don't know if that's the process that will take place, but if he were remanded to a jail cell at this point, he can continue to run for office. He can't vote for himself, which is a strange irony in all this, but he can run for office. So you would have, and you do right now have, again, pending appeal, and there will be one, a convicted felon running against an incumbent president. This is so beyond. I never use the word unprecedented because I think if you read the book of Genesis in the Bible, it's very hard to say that nothing that we experience today hasn't occurred in the past, or read any history for that matter. This hasn't happened in the United States. So this is a very, very different thing.
All that's missing is like a sponsored by Netflix, right? Like that's all this is really missing.
Yeah, I mean, this makes the West Wing look quite quaint by comparison, right?
I actually was speaking,
and I don't
to
mean to laugh about this. This is extraordinarily serious.
I was actually speaking to a political comedian last night, and he was like, Trump is actually the hardest person to do comedy on because he's just so ridiculous that you can't really make it more ridiculous. So it's going to be an interesting 6 months. So.
And the thing is, now it passes from ridiculous to serious in the sense that not that it's not been serious all the way through. And the world is going through several serious things simultaneously, right? I mean, we have the war between Israel and Hamas, which threatens to spread at times. We have the ongoing war between Russia and Ukraine, the threat of violence between China and Taiwan. We've got, domestic political concerns. This has taken that to a new level. And again, markets are very strange about these things. They oftentimes look through geopolitical events. They look through political events and find a spot that makes sense to them. I'm not quite sure, and I don't think we're not quite ready for futures to roll yet. So we'll see if there's any response after 2 down days that had more to do with earnings and interest rate expectations than anything having to do with DC politics.
So as I see it now, I'm reading here that they've got to set a deadline to submit sentencing memos, right? So could it be that he gets sentenced, goes to jail in the time in prison? And that's the comedy of the whole thing.
Yeah, I mean, and tragedy as well. I mean, it's. I remember there's a line in a Woody Allen film called Crimes and Misdemeanors where the Alan Alda character, who was one of the co-leads, said, comedy is just tragedy plus time. We don't have the time yet. This is tragedy playing out, in real time at the moment. And in a certain sense, while if you were a writer for Saturday Night Live or any of the night show, the late night shows, you may find some, justifiably given your role, you'll find some humor in this. But this is on orders of magnitude, a larger scale event now in many ways than Watergate. I mean, Richard Nixon was told by Barry Goldwater and others to walk away, before any of this could possibly happen. Donald Trump never received such counsel to either, pass on running again or do something that might allow him to live out his days in the setting in which he had become accustomed. And so I think this is such a multi-layered event in so many different ways. This obviously changes the arc of Donald Trump's legacy in the way he would view it. Obviously, he's now got to put, at least for now, unless overturned on appeal, convicted felon on his resume, if you will, and he's going to have to run as a convicted felon for the highest office in the land. So this is just big stuff.
I see them booking out the Sphere in Vegas and live streaming Trump from jail. He's doing this. It's just like
some enterprising individuals might find ways to make money off this. Yeah.
So moving on from the verdict, can we talk a little about the economic landscape we find ourselves in today? PCE comes out tomorrow. We've spent the year swinging from expecting 7 rate cuts to now expecting maybe like 5 over the next 2.5 years and just like 1.5 this year. Where are you on the inflation front? What do you believe are like clear leading indicators, and what may be more lagging indicators that we're seeing in inflation numbers right now?
Yeah, I'm still reasonably optimistic that inflation is going to come down noticeably this year. I know John Williams, the president of New York Fed, made similar comments that it's currently too high, but will likely come down in the second half and move closer to the Fed's 2% target. Look, I think we're in a window where, and I'm really going through some serious soul searching about how I feel about the entire rate hiking process relative to inflation over the course of the last year, because so much of it was supply chain disruption, so much of what was post-pandemic stimulus, some of which is worn off. And what we're dealing with now, what is people most upset is the absolute level of prices, not the rate of inflation. And they conflate the two, right? So we've gone from a 9.1% rate of inflation to about 3.5 CPI. The number we get tomorrow, the personal consumption expenditure deflator in the personal income and spending report, is likely to be 0.2%. It's going to be maybe the lowest print we've seen for that number, which the Fed favors throughout this entire series of inflation numbers. And that should give people comfort, if indeed that happens, that inflation is continuing to ebb. And so it opens the door for, and I guess we're going to have to wait till the third quarter for a rate cut. I'm still holding out some hope that we can get one in July, because I do think that it's the level of interest rates, particularly with respect to things like housing and auto purchases, is really hurting a lot of people. And, Larry Summers, with whom I've disagreed vehemently over the last several years, first of all, with his comparison to this period in the 1970s, which I thought was wildly off the mark. But he's even admitted now that the level of interest rates is, in fact, inflation. The cost of capital is inflated for the average individual, particularly middle and lower income individuals who either don't have access to credit or have to pay rather dearly for it. And then also prices them out of buying a home. It prices them out of buying or leasing a car. So I think the Fed's gone too far. I think inflation would have come to this level if the Fed had gone to 4% rather than 5.25%, 5.5%. So I think we're still on the way down. I think the Fed is confused and conflicted, and you have more disparate voices in this Federal Reserve than in any I've seen in prior periods. So I think in that regard, it's more of a struggle to get a consensus to make a move one way or the other.
So Ron, like just circling back, talk about some of the financial prognostications in a bit, but let's circle back on IFI-AI. What is it? And how do you feel about being a CEO after interviewing so many CEOs?
So this is my third go around in management. So I did run a fund of funds business from 2006 to 2008, which was not the most propitious timing for that experience. Actually, the fund itself didn't do terribly. It was the operating capital that we were short of that forced me to sell the fund. So iFi.ai is a AI-based stock forecasting service. It's a SaaS business, a software service business, where on the institutional side of our business, which doesn't share our name, by the way, but the institutional side of the business has $6 billion in assets under advisement, where we use artificial intelligence to create asset allocation models, create portfolios for institutions who then may or may not either use them internally, sell them to their high net worth clients in the form of constructed portfolios, bespoke portfolios, and the like. So there's about $6 billion in AUA there. And now on March 28th, we launched iFi, and we're transporting that very same technology, that artificial intelligence technology, to forecast the direction of individual stocks and exchange traded funds for self-directed traders and investors. And then at the end of June, we're rolling out a platform for investment advisors, which will include not just that forecasting capability, but also portfolio analysis, portfolio construction tools, and asset allocation models. So the advisors who are increasingly under pressure to grow their businesses, either through gaining more wallet share from their existing clients or prospecting for new clients, can worry less about the investment process and utilize some of our tools to not only because we think they're, and we've seen this in the institutional space, because they deliver, solid returns with relatively low volatility, but then also frees them up to do the things that will help their businesses grow, rather than try to, in some cases, do all the work on their own, including making all those investment decisions that they, are forced to do with respect to portfolio analysis, asset allocation, and the like.
Can you review some of the factors going into your predictive solution here? Like, what are the main things that it's feeding from a data perspective?
So it's literally almost everything. We get about 1 million bits of data per day that go into Watson X, which is the platform, the AI platform that we use to offer these, forecasts, which are on individual stocks and ETFs, 1 day and 1 month forecast. We'll be adding 1 quarter forecast as well. And so you'll get news flow, you'll get sentiment readings, you will get technical analysis, fundamental analysis, Wall Street analysis that's all fed through the Watson X artificial intelligence platform. And then that delivers back to us on all the publicly traded stocks in the US, a forecasted rate of return for 1 day and 1 month. And again, over time, those periods can be extended even out to a year. So if you're not a self-directed trader and you are an investor looking for capital gains, we may at some juncture have a 1 year forecast in order to allow people to just, kind of pick the stocks that they like and sit back and hope that they're going to produce capital gains. This is really for self-directed, traders and shorter term investors who, typically reside at Schwab or TD or E-Trade or Robinhood or eToro, places like that. And so all those factors go in. And on the institutional side, we run about 50,000 models per night. And so we are crunching an extraordinary amount of data and looking forward to the day, by the way, when Watson X unveils its first quantum computer, which is going to give us even more breadth, more depth, and more scale to do this. We're targeting, from a directional perspective, 80% accuracy. We're currently, from what I understand from my team, about 70% accuracy rates on the directional forecasts that we make. So if you think about, a successful hedge fund manager who's right big 51% of the time and wrong small 49% of the time, we're trying to mimic something like that. And then when it comes to the advisor side, the portfolios that we'll be offering out, we're hoping to have, S&P plus returns with presumably about half the volatility, which would be a real sweet spot for a lot of advisors and their clients, because that would, kind of cut down on the amount of anxiety that comes with being fully invested, at any given time.
Can that be achieved this year without an overweight to an NVIDIA, or no?
Well, look,
You're like, outperformance half the risk. I was like, sounds like an overweight to NVIDIA. That's what it sounds like.
Well, yeah. I mean, well, like that's been one of the interesting things about this year. I don't necessarily compare this period to 1999. I don't think we're that far into the bubble. I know the concentration of the Magnificent Seven inside the S&P 500 is as high as or higher than all of tech was in 1999 and 2000, which I covered quite closely, as you can imagine. But I also think that, and I had a conversation with Dan Ives. We're going to be adding, by the way, to our service, iFi Live, which is going to be conversations about artificial intelligence and artificial intelligence as it affects both the markets and the financial services industry. So I was talking to Dan Ives in one of our inaugural interviews yesterday, and we both come to the same conclusion that we're in about 1995 as far as AI is concerned, relative to the rollout of the internet. That we're moving through the infrastructure phase and now moving out to the implementation phase, where these tools are now becoming increasingly available. Financial services, legal services, pharmaceutical development, healthcare services are going to start deploying, even quick service restaurants for that matter, deploying these AI tools and enhancing their productivity, enhancing their efficiencies. And I think that's the next wave that we're going to see in the space. And clearly, I'm making a bet on that myself, that these tools can enhance the productivity, both of, again, the self-directed individual or investment advisors or institutions who want to use tools like these to arrive at solutions that, often take scores of people and millions of dollars. And we think that we can even create some cost savings for individuals and institutions on with products like these.
I think that totally makes sense, especially from like a valuation perspective, because as if you look at the earnings that are expected on NVIDIA, it's expected to grow into an actual reasonable company versus the tech companies of the late 90s.
Oh God.
But
Yeah.
you didn't have as bad of a deficit problem from the government during that period. So whether it's the government deficit or small caps inability to actually show earnings growth, of which a significant portion is priced in for Q4. Like, is it going to matter what inning you are in the artificial intelligence wave if there are other disruptors to the market?
Well, I mean, yes and no, right? I mean, if you go back from 1995 to 2000, there were disruptions in the marketplace. If you remember, in 1997, we had the Asian currency. Well, let's go back to 1995. We had the Orange County bankruptcy. We had the Mexican peso crisis, which affected markets briefly. Then 97, we had the Asian currency crisis and actually had a mini crash. 98, you had the Russian debt default and the collapse of long-term capital management, which created a real serious systemic challenge. The Fed eased into that, and we got another year and a half of economic growth, and we had an explosive blow off top in the market. You remember in 1999, NASDAQ was up 85%. So yeah, these bull markets or bubbles or technological transformation periods can be interrupted at times, but I think this is a large enough change in the scope of technology that, yeah, it could be disrupted by, God forbid, some sort of problem with the national debt. Although I would argue China and Japan are much bigger debt risks than the United States. China's debt to GDP ratio, when you look at it appropriately, is 288%. Japan's is 255%. Yeah, we could have any number of problems here at home. We could have a world war, for God's sakes. I mean, something could happen that would derail this. But I think this fourth industrial revolution, as it's sometimes called, is real. And I personally would not have made a bet on it if I thought it was a passing fancy. I mean, strangely, stupidly, at least personally, I went to my first Bitcoin seminar when it was at 100. If I'd put $50,000 in Bitcoin at 100, clearly I would not be sitting here talking to you, very nice gentlemen. I would be sending checks to family members from a very nice island, but I've never understood that proposition. I do understand, at least I think I understand what's going on here.
So along those lines, when I'm trying to forecast the future off of the past, I struggle with how AI can anticipate the future, which is potentially explosive and unknown off of the past. Help me out with that, because and please don't talk about what was happening in 1850.
Yeah, I wasn't around for it. I was born about 10 years later in 1861, just as the Civil War was breaking out. No, look, I think that's a very legitimate question. Is like, how does AI anticipate the future? I think certainly not in a perfect sense. Like I'm not a believer that this is going to be something that is foolproof, bulletproof, where you're going to get 100% accuracy, no matter how you use it. Now, it's interesting what's being done in the pharmaceutical world, where an AI program or AI solution can anticipate mutations in certain proteins or viruses and help with drug design. That's a different question, right? I mean, can you get a perfect prediction of the future when so much of human behavior itself is potentially unpredictable? No, I don't think that's possible. Can you raise the probability that people make better decisions using AI tools? I think that's the central question, is how do we assist, not how do we replace, right? I think that's where people get really balled up with respect to AI is the replacement question. Are we going to put everybody out of a job? It's interesting. One of the other interviews we did for iFi is with Melanie Mitchell, who wrote the book Artificial Intelligence back in 2019. And she is, as an AI researcher, as a behavioral psychologist, and as someone who's really a cognitive psychologist, as someone who is really steeped in this and has really understood the history of the development of artificial intelligence, which, by the way, goes back to the 1950s. Very few people realize that they've started working on this, over 70 years ago. I'm not looking for perfection. I'm looking for a service that will assist individuals in their endeavor to do better, utilizing platforms like Watson AX, which can ingest just so much more information than any individual can take in a given day, process that, and then arrive at a conclusion that's reasonable. And look, we've seen it happen a couple times, within iFi. We had, and I was looking at it incredulously. We had a forecast at one point several weeks ago that Tesla was going to go up 40% plus in a month. A day later, they report earnings, it goes up 35% in 5 days. Right. And so I'm taking that as a win. And if I were talking to anybody on the site, I would say, look, 35% is 40%. If you're a trader, take your profits and go home. Right. Now, granted, we also want you to look at the next fresh forecast to see whether or not that forecast is intact, or whether, the data that we've taken in has forced a change in probabilities of that happening. But that happened with Snap just yesterday with Marathon Oil. We had it going up 20% in a month. It went up 10% in a day. So one thing, and it's not to say there haven't been some inaccurate forecasts in there as well, but when you see that happen, then you say, okay, this is pulling in information that either it weighted improperly, didn't have access to, couldn't take in, didn't have the ability to take in myself, and so it raised the probability of me making a good decision. That's, I think, really at the end of the day, the goal. Not a perfect
You were
forecast for the
citing
future.
80%. You were citing 80%. That means anything north of 60%.
Yeah, I think we're currently, from what one of my senior colleagues told me, is right now we're running directionally at about 70% accuracy. The goal is 80%. So if you can do that, that's a big win. And who knows, we might call you guys with a few ETFs that, take our top 10 best ideas and, run with them.
Without giving away, obviously, the secret sauce, and I assume you guys can do an attribution to see what signals are really adding value. As you eloquently alluded to, like, AI is not suited to price predict. It's more to compute large sums of information or extract the valuable pieces of information. So is this like last minute analyst revisions? Is this news chatter? Like, what are the timely signals that you're seeing that's like really, is it like just trading on the days leading up to the announcements?
So the answer is yes. Right. I mean, that's the whole point, right? It's all of the above. It takes in as much information that's available to us as possible and weights it appropriately. And of course, one of the interesting things about Watson X versus other platforms is the way in which they filter data so that you're getting the highest quality data available to you. And it adjusts and addresses things like bias and drift. So again, you're trying to produce the highest quality forecast or outcome that you can using their tools. We're not clearly with Watson X, we're not the only enterprise, on their system that's doing this. And so it's the old expression, garbage in, garbage out. We're trying to avoid taking in garbage, right? So the way news flow is weighted is on the quality of the source of the information, how often it's referenced down the chain, technical analysis, sentiment analysis. I suspect at some juncture, and I don't know this yet to be true, I'd have to have a further conversation with our team, but the process itself may at some juncture become self-referential, right? Where we're generating enough sentiment that may, because we don't want that to affect the outcome, that will have to be weighted into the various inputs that we get, the signals that we get. And the signals are rated, right? If you go into the system, if you go to the website itself is i-fi.ai. When you go in there and you click on a stock, it'll give you the forecast. It'll give you a low forecast, a high forecast, a degree of confidence, historical accuracy, a generative AI summary of why the model thinks these forecasts are going to come to pass. And with that, there's an entire list of all the signals, positive and negative. and how they're weighted. And so you yourself can actually see that within the body of both the website and the app, and understand that, okay, so you're looking at a particular stock and this is weighted most highly. Now, it's interesting, it's funny, I had some questions for my team. At one point with the Tesla forecast, the producer price index was weighted heavily. And I said, okay, so how are we adjusting for correlation versus causation? But this is what deep learning systems do, right? Is that they're understanding that when this happens, that happens. And so the systems are constantly being retrained. And the more powerful the computing capability you have, and as you guys should know, these are all based on neural networks. When you get into deep learning, the system begins to teach itself and re-weight all the various signals to improve the probability of the forecast being accurate. So this will always be a work in progress, and this is how it differs, by the way, from quantitative analysis, which is static. This is far more dynamic. And so, in my mind, we are not. I don't think any AI process is yet finished because of the continual learning component of this. So it is always a work in progress, and you're always striving for more and more perfection, or getting closer to perfection. The same way, when you're running a Six Sigma program at GE, which used to own CNBC, FedEx and Monsanto and others and other companies that had employed these systems, you're always trying to learn more, do better, be more accurate, be more helpful.
Ron, when it gives a recommendation about a buy signal, does it also give a recommendation when
No, that's something we've not done, because for a couple of reasons. Number one, we don't want to be an investment advisor. That's its own business, right? Once you start making recommendations of when to buy and sell, you're either going to be in the RIA business or you're going to be in the broker dealer business, and we don't want to be in either. There's layers of complexity there from a compliance and regulatory perspective and a legal perspective that that's not what we're trying to do. We're not trying to say buy this, sell that, or buy it now, sell it there. I do believe we are going to, and we're in the process of creating alerts so that people know when they've approached their target, at different points along the spectrum, so that they can make decisions about whether or not they've had enough, right? If you're up 10% in a day and it's a 20% forecast for a month, 10% in a day is better than 20% in a month. So, as someone who's had some experience trading, do you want to take profits? Do you want to lighten up? We'll have some indicators for people that they will know where they sit with respect to when they got in, how close they are to, achieving the goal that they've been laid out, or the forecast that's been laid out for that period that they picked.
Do you
And we have 1 day
it's-
forecast too, right? So now that there are all these 0-date single stock options traders who are quite active in the marketplace. And so we do want to offer them, a tool as well that may assist in that process.
Do you ever worry it's going to get too good, stop sending signals, set up its own hedge fund, and just be like, "Screw you guys"? I'm gonna
take the hard work and run. Yeah. Well, this is okay. So this is an interesting question, right? So this is where the philosophy around AI comes in. Is like, will we achieve Ray Kurzweil's singularity? Will us become smarter than we are, and then suddenly begin to, not only think but also feel and act? I'm not in that camp. Melanie Mitchell, I think I had a really first time I've ever spoke with her yesterday. Fascinating conversation. The complexity of human thought still escapes, I think, a lot of data scientists. There are things that we do well. She had a very interesting example with an autonomous vehicle that kept stopping when it saw a billboard with a policeman who held up a stop sign, which it mistook for a stop sign, right? We can understand that complexity. We could either have a stop sign in front of us and that billboard there, and we know what to do, or that billboard might be there without a stop sign, and we're not going to stop at that intersection because it's not called for. So do I worry about it? Not yet. I mean, obviously, if this does well enough, we may have done well enough not to worry about whether or not it's going to overtake us and hold a board meeting and launch a proxy fight and kick us all out. That would be I think some iterations down the road, I think we're satisfied that the service that we're providing will be helping people, and hopefully we'll learn some new things ourselves.
And is the service offered to retail
Yeah.
different in the context of its timing of execution versus the institutional side?
So institutions are asking for different things. They're using asset allocation modeling. They're doing portfolio construction, portfolio analysis, and like we were able to transport the technology that's used because in some cases, and this is done for some large institutions outside of the United States, we have data on 50,000 publicly traded stocks, 3,400 of which are here in the United States. And so we're just transporting the technology over. Institutions have different goals. So, in some instances, you could be selling an indexed, annuity, and they may want a direct indexed or index linked product that we can create and that they can then utilize inside of an annuity package or an asset allocation model. Whereas in this instance, for individuals, for self-directed traders, really specifically and investors, this is forecasting the direction of individual stocks on a 1 day and 1 month basis. And so for investment advisors, we'll be offering the portfolio tools that may be useful to them, either portfolio analysis, construction, asset allocation models, model portfolios, and things like that. Most individuals don't really involve themselves with that type of work, unless you're really, if you're really well-heeled, you're managing your own money and you want to create an asset allocation model, or you want to kind of play around with creating your own sub-index. That's something people can kind of do on their own. It's not that easy to do, which is why they turn to advisors in the first place. So we want to lend a hand on both sides. So for people who do enjoy and who do actively trade, of which there are many these days, we'd like to lend a hand.
The stock model makes sense to me. I am having a hard time understanding how the allocation process works, in all honesty, just because if you're looking at historical data to put together asset classes, you're inevitably taking into account their historical return and correlations over time. And how do you not just end up in a momentum portfolio of overweighting the best performers? How do you?
I hope we're overweighting the best performers.
Well, future performers, right? Not past
Right.
performers, right? So I think that's the key there is how do you test it out of sample? What are you doing on that side to ensure you're building a best breed portfolio? And also when you have these market environment changes where it's hey, AI system, I know you have zero data in the last 10 years on inflation, but guess what?
Yeah.
We're going to throw inflation at you, right? How quick does that learn and reassess that, oh my gosh, bonds are not really protecting, the 60-40 is dead? When do you realize that in that essence that a 60-40 portfolio needs to be introduced to commodities or precious metals or something like that? What are your thoughts on the allocation side?
Well, so some of this is bespoke, right? So with some of the institutions, and this predates my joining the company, but some of these portfolios are bespoke. And then some of the institutions that use them may use the indexes that we have or have created, or the portfolio tools that we've created, and then modify those themselves for within the parameters that they set for their asset allocation modeling, right? I understand how we do the modeling, but there may be an institution out there, and I know there is one that, for instance, puts a volatility overlay on the portfolio, right? So they're looking to dampen volatility and get some sort of, it may not be in this country, so it won't be necessarily an S&P style return. It may be whatever benchmark return they're trying to deliver with a much lower vol. And they may create sub-indexes themselves that they include. So a lot of the work that we do on the institutional side is bespoke and in conjunction with the goals and objectives that the institution set out for us to provide those tools for them. So it's a little different than just saying, okay, here's a mass market asset allocation model. You all can play with it as you like. And, for those of you who just want to buy, a portfolio that's rebalanced weekly, let's say, have at it. That's not the process that we're going through on the institutional side. Look, I would, having run a fund of funds for a period of time, I would love quite frankly, for us to create an asset allocation model that works better than anybody else's, it would be available to the public. That would be a beautiful thing. And I don't know what package it would come in, whether it's an exchange traded fund or some other vehicle, but you've seen some that haven't performed terribly well, over time, that were, created in the professional community. And so to the extent that, and we're not doing this for individuals, obviously, but to the extent that that's a possibility in the future, it's something that I personally, both in terms of traditional public markets and publicly available assets, and also in private markets, given the amount of data that exists now today relative to when I was running a fund of funds, when you could not get real-time data on individual hedge funds or private equity managers or venture capitalists or what have you. There's so much more available data. I still believe that our models could take a look at hedge fund data and derive an actively managed portfolio of alternatives that would do quite well. That's a personal belief. It's not something we're working on right now. I think down the road we probably might take a stab at it, because I love that space. But again, with the availability of big data, with these deep learning networks, with these processes that are underway, it's only a matter of time. And believe me, we're not the only people trying this. I mean, every large institution is talking about utilizing AI internally for their processes in financial services. So we know it's a competitive marketplace. We just hope we're going to be able to do it better.
I figure if you get the right sector right, you're going to have a better shot of outperforming. Is there anything that you can share with us today that your system is saying about sectors, whether it's overweight energy from 3.5% to 5%, or technology is too high, or you get my
I mean,
point.
like, I don't have to be blunt. I don't have a lot of visibility into those models, because that's not part of my remit, if you will. I'm working on a separate bit part of the business. And so I have not yet seen all the kind of internal components of these asset allocation models and other products that we have institutionally. They also happen to be international. And so I haven't traveled to some of the places where we're doing business. We're doing some, obviously, in the United States as well. But I don't have any particular insight on that, other than the conversations I've had with the teams that are working on that, and my colleagues at the, in the business. What it's saying, I don't have that. Like, it's not, in a certain sense, it's kind of, particularly the way in which some of these asset allocation models work, what it says today versus what it says next week might be two different things. And that's the whole point of having a dynamic asset allocation model running, is that it's not necessarily saying I love technology forever. It may be saying I love technology for now. So that's kind of more the way in which these models work. It's hopefully, at least right now, there's no emotional commitment to a particular sector that leaves you in there for too long. And we know that this is a problem for humans, right? I mean, people become very, very attached to their positions. And listen, sometimes they sell out too early. I mean, I know a couple of advisors, by the way, who bought, and they still own it, God bless them. They bought Nvidia at 30. I mean, and they bought a fair amount of it. And we were having lunch a few weeks ago, and they were trying to decide if they should sell some of it before the earnings came out. You're kind of like, what's the point? Like, you're long Nvidia, like, kind of for your, and I don't mean to sound like a California boy, Valley boy, but you're long Nvidia almost as an estate planning tool. It's not the type of stock you trade. It's the type of stock you own. But our models don't tell us that explicitly. They don't say that until we see a change in forecast. We don't, and they can't tell us ahead of time. So we can't, like, what the beauty of that is, you can't front run your own model, right? You can't step out in front of the public. We don't know anything that the public knows before they know it. And we're not trading any of it ourselves, which is, even, I think, from my perspective, extremely important. You don't want to be out there, making recommendations, having already purchased something, in front of the very clients you're trying to assist.
Dan, unless you have other questions on the system, thank you. And I apologize if we grilled you. It was just because of our own personal interest. And
No,
found
look,
that very, very
I'm telling you, I'm
fascinating.
growing
So
increasingly
thank you on that.
fascinated. I would read Melanie Mitchell's book. I didn't know it, you know, I hadn't seen it. And, you know, there are other people whose names are, you know, more recognizable in the field. But she does this wonderful or you can watch the interview, which I think in a week or so will be up on iFi. But she does this exhaustive history of guys like Douglas Hofstadter and others, whose names no one's really necessarily familiar with. Alan Turing, obviously, and the Turing test, and how that was used to determine whether or not artificial intelligence was meeting human intelligence standards, if you will, or could you know, we know about the Big Blue challenge at IBM, you know, beating Garry Kasparov, or Go or Jeopardy, and all these different things that have transpired. But the history is really fascinating, and how there have been, as is the case with every other transformational technology, from an investment and support perspective, winters and springs and winters and springs with respect to how this has moved along, and how much money has flowed towards it, how much intellectual capital has flowed towards this space. It's been going, you know, since about 1955, and you know, and Turing obviously before that, because he was, you know, a code cracker and a computer scientist long before anybody even knew what that was. But it's a really fascinating history, and the current environment equally so.
Thanks
unless
very
you-
much, Ron. We're good. We're good. I appreciate it, Ron. Thanks very much for joining us today. I look forward to trying out the app and stay in touch.
No, please do. Yeah, absolutely. Thanks for having me. I really appreciate the time.
Fantastic show. Thank you so much.
Thank you. Be well, guys.
Thank you.